as to what exactly is happening within the entire metal space. Do remember whether or not it's going to continue to lose sheen, what the China stimulus means. We've got Rakesh Arora, the founder at Go India Stocks, joining in. Thanks so much for taking time out. To begin with, I just want to understand what the outlook is for the sector as a whole, because there has been that underperformance. Do you believe that this will only likely continue?
So, while the macro factors are, conducive of rally in commodities, because at one end we're expecting China to provide stimulus, and also overnight there was some, news flow around it that China is pushing more stimulus. On the other hand, you have interest rate cut expectations in the developed world, and probably that would also lead to slightly weaker US dollar. So these things normally are supportive for a commodity price rally. However, there's two, three things which are missing. One is that demand is missing. Despite the push by China, the demand really hasn't really picked up. On the contrary, China has been going all out in terms of production, and they've been exporting all the surplus metal into the world, and that is really pushing, prices downwards. And the second issue is that given the buoyancy in Indian market, metal stocks had actually moved up way ahead of fundamentals, and that's why we are seeing a little bit of pullback. So I would say for 2024, there would be a little bit more volatility than what we saw in 2023, because there's always a lot of hope, but the reality is slightly difficult, and so markets will gyrate between hope and reality checks.
Right. But on the other hand, Rakesh, it's the mining stocks which are on fire, right? Tell me what are the dynamics at play here and whether you see this outperformance continue.
So you're right. There's a little bit of divergence which is coming in between mining and processing, industry. So mining industry is largely dominated yeah, by Canada, Australia, and Africa. And there's been a lot of underinvestment into the mining sector, whereas processing sector is largely dominated in China, where there has been overinvestment. So there's a little bit of mismatch. That's why raw material prices, whether it is coal or iron ore, they've been going up at this slightest of uptick in production of processed metal like steel. So steel prices have come down, mining, commodity prices are up, and steel margins are low. So one can say that it is safer to be with mining commodities as compared to processed commodities.
Right. Okay. So then, the question really boils down to, Rakesh, what do you do with holdings, or if you're completely out of the metals and mining sector right now? What's a good buy? What's a good avoid?
So what I would say is that one should look at integrated companies which are indicated for raw material. They would be in a better position to weather this kind of volatility that we are seeing, and the margin compression which is coming from raw material prices going up. So my preference would be for integrated companies. There again, look out for companies which have low debt, so they are safer bets.
Point taken. So that's about the entire metals pack. But I want to shift focus, Rakesh, and talk about the cement space, because there was a recent brokerage note talking about how consolidation is likely to continue. 65 million ton capacity is still there, which is almost 11% of the total industry, which might be up for consolidation. Do you think it's only Adani which will continue to grab the maximum amount of capacity here, or do you see any other player also participating in this inorganic expansion?
So largely, there are two players, Ultratech and Adani's, who are competing with each other. And so there's a little bit of, tussle going on in terms of who would take over maximum number of, facilities available. So I would be surprised, if the deal happens outside of these two groups. I mean, obviously, there's a chance that others can pay more and take it, but at the moment, we have seen that the other players like Shree Cement, etc. Shree Cement particularly has been very conservative, and Alme has been more aggressive and adventurous. But then they've been buying the assets which have been left out by these two. So largely, I think it will be Adani and Ultratech who would be driving the consolidation in terms of mergers and acquisitions. But in any case, the large part of growth is coming from the top five, six players. So all the new capacities are being put up by these guys, and there's a natural consolidation already happening. So consolidation is a theme which will continue to run for the next few years in cement industry.
Consolidation is likely to continue, and two major players who are the likely beneficiaries. But within the entire sector, in terms of the demand supply dynamics, how it's shaping up, it doesn't seem like companies still have a lot of pricing power. How do you see the demand and supply pressures for the industry right now?
So last quarter was a little bit weak. Demand was in mid single digits, and but companies did benefit from reducing cost, and the margins are expected to be higher in Q3 results. They are likely to be out this month, so we will see that margins have expanded for most of the cement companies. Going forward, I think in the run up to the general elections, demand should come back, back to double digits that we were seeing till now. And, government would be in a little bit of hurry to complete projects before the elections. So next 6 months, I think demand should be reasonably buoyant. And since we are into busy season of the year, cement prices will be also well supported. So I'm expecting, next 2 quarters will be one of the best quarters that we've seen.
Interesting. Rakesh, great to have you on the show and get in all that insight on metals and cement and how investors should be looking at both those sectors. Okay, on that note, we're going to take a very quick